543. Silver tried to stop itself at 100. It hesitated. It paused. And then it didn't stop. This number wasn't supposed to happen yet. Not this fast. Not like this. For years they said silver was finished. Too boring. Too slow. Just an industrial metal. And now it's crossed the line everyone said it never would. So here's the real question. If silver can break the one barrier that stopped it for decades, what happens after resistance is gone? Stay right here, because what comes next is what most people are completely unprepared for. Welcome to Market Metal. If you've been watching markets for a long time, if you've seen cycles come and go, and you still believe patience beats noise, then you're in the right place. I'll ask you gently, like I would an old friend, if this kind of clear, calm market talk matters to you, please take a moment to subscribe. It helps keep this channel steady and strong. And before we begin, tell me something. From where in the world are you watching today? The moment the line was crossed. Silver crossed $100 an ounce quietly without ceremony, but the significance of that moment was anything but small. In financial markets, certain numbers act like invisible walls. They are not created by law or physics, but by collective belief. For decades, $100 was such a wall for silver. Traders spoke of it as a theoretical ceiling, analysts dismissed it as unrealistic, and institutions built their models around the assumption that silver would never stay there. When that line finally broke, it signaled something far more important than a price increase. It marked the end of an era. In the hours following the breakout, many observers focused on the speed of the move. Futures prices pushed higher, spot markets adjusted, and headlines began to appear. But experienced market participants understood that speed was not the story. The real story was permanence. Silver did not spike briefly and retreat. It crossed the level and held above it. That distinction matters. Markets often test resistance levels many times before breaking them. What makes a breakout meaningful is not the act of crossing, but what happens afterward. In this case, silver did not behave like an overextended asset. It behaved like one entering a new pricing regime. From a structural perspective, the $100 level had served as a psychological anchor. Anchors influence behavior by shaping expectations. When traders believe a price is impossible, they position accordingly. When producers believe a price is unsustainable, they hedge differently. When institutions believe a level will never be reached, they ignore the risk entirely. Once that anchor breaks, behavior changes quickly. Positions are reassessed. Risk models are updated. Long-term assumptions are questioned. This is why round numbers matter so deeply in markets. They represent shared belief systems. The silver market has a long history of being underestimated. For years, it was framed primarily as an industrial input rather than a monetary asset. This framing allowed analysts to downplay its strategic importance. Industrial metals, the argument went, respond predictably to economic cycles. They rise during growth and fall during contraction. But silver has always existed in a dual role. It is both an industrial necessity and a store of value. That dual nature creates unique pressures when monetary conditions shift. The move above $100 forced markets to confront this reality. Historical context is essential. Silver has experienced powerful rallies before, but each was eventually dismissed as an anomaly. In prior decades, spikes were attributed to speculative excess, temporary shortages, or isolated events. The underlying assumption was always the same: the market would normalize. What made the current breakout different was not just the level reached, but the environment in which it occurred. This move happened during a period of persistent inflation concerns, rising sovereign debt, and weakening confidence in long-term monetary stability. In that context, silver's behavior looked less like speculation and more like repricing. Repricing is a critical concept. Price movement suggests fluctuation around a stable value. Repricing implies that the stable value itself has changed. When an asset is repriced, previous reference points lose relevance. Analysts who continue to rely on old ranges often misinterpret what they are seeing. They look for a top when the market is actually searching for a new equilibrium. Silver's movement suggested that the old equilibrium, defined by decades of suppression and underinvestment, no longer applied. Institutional reaction patterns supported this interpretation. Large capital allocators did not rush in during the early stages of the move. Instead, they waited for confirmation. This behavior is consistent with how institutions manage risk. They prefer to enter after uncertainty has resolved, even if it means paying higher prices. The confirmation they were waiting for was not a technical signal. It was behavioral. Once silver held above $100, it demonstrated that sellers were no longer able to force it back into the old range. That failure changed the risk calculus. At the same time, the language around silver began to shift. Commentators stopped asking whether the move was real and started asking what it meant. That change in narrative often marks the midpoint of major market transitions. Early on, disbelief dominates. Later, acceptance sets in. Finally, normalization follows. The market had clearly moved beyond disbelief. Acceptance was beginning, but normalization had not yet occurred. This is typically the phase where volatility increases, not because the trend is weak, but because participants are adjusting at different speeds. Another important element was the absence of panic. Breakouts driven by emotional excess tend to be accompanied by frantic buying and sensational coverage. This breakout was measured. Volume increased, but it did not explode. Commentary remained cautious. Many participants openly expressed uncertainty. From an analytical standpoint, this restraint was a strength, not a weakness. It suggested that the move was being driven by structural forces rather than crowd psychology. For decision makers, the implications were immediate. When long-standing assumptions fail, strategic frameworks must be updated. Businesses exposed to silver through supply chains, hedging strategies, or capital planning could no longer rely on historical averages. Investors who treated silver as a marginal asset had to reconsider its role. Policymakers watching commodity signals had to acknowledge that markets were pricing in deeper concerns than short-term inflation. The crossing of $100 did not answer every question about silver's future. It raised new ones. How high could a repriced market go? How quickly would institutions adapt? Would this shift alter broader commodity relationships? Those questions would be explored in time. What mattered in this first moment was recognition. Recognition that a boundary once thought immovable had fallen. Recognition that silver was no longer behaving according to old rules. In markets, the most dangerous moment is not when prices rise sharply, but when assumptions quietly break. Silver's move above $100 was such a moment. It did not announce a peak. It announced a transition. For those paying attention, it was not a signal to celebrate or panic. It was a signal to think carefully, reassess calmly, and prepare for a landscape where past expectations no longer applied. What changed beneath the surface? While headlines focused on silver crossing $100, the real story unfolded far from trading screens. The breakout did not begin on the day prices surged. It began years earlier, quietly, in places most market participants rarely examine. Beneath the surface of daily price charts, structural pressures had been building, layer by layer, largely ignored by those relying on traditional models. By the time silver moved decisively higher, the outcome was no longer negotiable. It was delayed, not accidental. Silver is unlike most commodities because its supply does not respond easily to price. In many markets, higher prices encourage producers to increase output. New projects become viable, capital flows into exploration, and supply gradually catches up with demand. Silver does not follow this pattern. The majority of silver is produced as a byproduct of mining for other metals such as copper, lead, and zinc. This means silver supply is determined not by silver demand but by conditions in entirely different markets. Even a sharp rise in silver prices cannot quickly increase production. This rigidity is one of the most misunderstood features of the market. For years, this constraint was masked by the paper market. Futures contracts, derivatives, and exchange-traded products created the appearance of abundant supply. On paper, silver was plentiful. Physical reality told a different story. Industrial users required steady deliveries. Mints needed metal for coin production. Energy, electronics, and defense sectors depended on silver's unique properties. As demand expanded, especially in high-growth technologies, the gap between paper availability and physical availability widened. That gap was manageable until it was not. Investment in new silver supply had been declining long before prices moved. Mining companies, shaped by decades of low prices and poor investor returns, were reluctant to commit capital. Exploration budgets were cut. Development timelines stretched. Environmental and regulatory barriers increased. These decisions made sense individually, but collectively they created a fragile system. When demand finally pressed against it, the system had no flexibility left. At the same time, demand itself was becoming less optional. Silver is not easily substituted. In many applications, even small amounts are critical. As industries expanded, they did not reduce silver use when prices rose. They absorbed the cost. This is a key difference between silver and purely discretionary commodities. Demand did not retreat as prices climbed. It remained firm, even as inventories thinned. That behavior signaled that the market was no longer operating under normal elasticity rules. The paper market continued to function, but strain was visible to those who knew where to look. Delivery schedules tightened. Lease rates rose. Inventory movements became more frequent and more directional. These were not signs of panic, but of adjustment. Large players were positioning for scarcity, not abundance. They were preparing for a world where physical silver commanded a premium over financial representations of it. Another overlooked factor was time. Structural imbalances do not resolve quickly. They persist, often invisibly, until a trigger forces recognition. In silver's case, the trigger was not a single event, it was accumulation. Years of underinvestment met years of rising demand. Eventually, price had to reflect that reality. The breakout above $100 was simply the moment when delay was no longer possible. What made this phase particularly dangerous for unprepared participants was its quiet nature. There was no single warning headline that announced the shift. Instead, the signals were technical, operational, and behavioral. Those who relied solely on mainstream commentary missed them. Those who studied flows, inventories, and incentives saw the pressure building. When the release came, it felt sudden only because the groundwork had been ignored. Institutional behavior further confirmed the change. Rather than rushing to short the move, many large players reduced exposure or stepped aside. This restraint was telling. In previous rallies, short positions were built aggressively, betting on reversion. This time, caution prevailed. Institutions recognized that the conditions supporting suppression had weakened. When structural scarcity replaces cyclical tightness, old strategies become liabilities. The market's reaction also revealed a deeper truth about confidence. For decades, confidence in paper mechanisms allowed participants to assume that supply would appear when needed. That confidence depended on trust in intermediaries, exchanges, and settlement systems. As physical tightness increased, that trust became conditional. Participants began to value certainty of delivery more than price advantage. This shift in preference is subtle but powerful. It changes how markets clear. Silver's rise, then, was not merely a reaction to inflation fears or speculative enthusiasm. It was the visible expression of an invisible breakdown, a breakdown in assumptions about availability, responsiveness, and control. Once those assumptions cracked, price had no choice but to adjust upward, rapidly and decisively. The suspense at this stage was not about how high silver could go in the short term. It was about whether the market would fully acknowledge what had changed. Would participants recognize that supply constraints were structural, not temporary? Would pricing mechanisms adapt smoothly, or would friction increase? These questions mattered far more than daily price fluctuations. For decision makers, the lesson was clear but uncomfortable. Markets do not always signal risk loudly. Sometimes they whisper for years and then speak all at once. Silver had been whispering through declining investment, rising industrial dependence, and tightening physical flows. When it finally spoke, it did so by breaking a level many believed unreachable. The forces beneath the surface were still in motion. They had not resolved with the breakout. If anything, they had been validated. The market was no longer asking whether silver should be priced higher. It was asking how long participants could operate as if nothing fundamental had changed. That question would shape every move that followed. Global confirmation and the pressure on control. When silver crossed $100, it did not do so in isolation. Markets that move alone can be dismissed. Markets that move together demand attention. What gave the breakout its true weight was the confirmation that came from outside the traditional centers of price discovery. Signals began to appear across regions, currencies, and exchanges, all pointing in the same direction. The message was clear. This was not a localized anomaly. It was a global adjustment. In international markets, silver had already been trading at higher effective prices. When converted into US dollars, prices in parts of Asia were consistently above Western benchmarks. This gap was not caused by speculation or policy distortion. It reflected differences in physical availability and delivery priority. Where industrial demand was most concentrated, buyers were willing to pay more to secure metal. This premium acted as a quiet vote of confidence in silver's scarcity. It also created pressure on global arbitrage mechanisms designed to keep prices aligned. Arbitrage relies on smooth transfer. Metal must move freely from where it is cheaper to where it is more expensive. But silver does not move instantly. It requires refining, transport, and settlement. When physical flows slow or tighten, price gaps can persist longer than models predict. As those gaps widened, they exposed a weakness in the assumption that Western futures markets alone set the global price. In reality, price is discovered where demand is most urgent and supply is most constrained. This shift had consequences for institutions managing exposure through derivatives. Futures contracts are efficient tools in stable environments, but they depend on confidence in delivery and rollover. As physical tightness increased, that confidence became conditional. Participants began to pay closer attention to inventory reports, delivery notices, and warehouse movements. These details rarely matter during calm periods. During transitions, they become critical. Short positioning offered another lens into the change. Historically, silver rallies attracted aggressive short selling based on the belief that price would revert. This time, the response was different. While some short positions remained, they did not expand in proportion to the move. In some cases, they declined. This behavior suggested that the perceived risk of being wrong had increased. When control over a market weakens, betting against it becomes more dangerous. The cost of error rises. Institutional caution was also visible in language. Communications shifted from certainty to conditionality. Analysts spoke less about ceilings and more about scenarios. Forecasts widened. Uncertainty was no longer dismissed as noise. It was acknowledged as a feature. This change in tone matters because it reflects internal recognition that models built on past behavior may no longer apply. When professionals stop speaking in absolutes, they are signaling that the environment has changed. At the same time, sovereign and policy considerations entered the picture. Silver is not just a commodity, it is a strategic material. Its role in energy transition, defense systems, and advanced manufacturing makes it sensitive to national priorities. As prices rose, governments and large industrial buyers had to consider security of supply. That consideration does not show up immediately in public data, but it influences long-term contracting and stockpiling decisions. Once those processes begin, they reinforce scarcity. The global nature of silver demand also limited the effectiveness of local interventions. Measures that might slow a rally in one market could not easily suppress demand elsewhere. This created a feedback loop. Higher prices in one region validated higher prices in another. Over time, these signals converged. The breakout above $100 was not the start of this convergence. It was the point where it became undeniable. Another source of pressure came from ratios and relationships. Silver does not trade in isolation from gold, currencies, or other commodities. As silver rose, traditional ratios compressed. These shifts forced portfolio managers to rebalance. Some reduced silver exposure, others increased gold allocations. Each adjustment created new flows, altering demand patterns across markets. These secondary effects often matter as much as the initial move, because they extend the impact beyond the original asset. What made this phase especially tense was the narrowing window for adaptation. Participants who recognized the change early had time to adjust gradually. Those who waited for confirmation faced sharper decisions. Should they trust old frameworks or adapt to new ones? Should they prioritize liquidity or certainty of supply? These are not theoretical questions. They influence hedging strategies, procurement policies, and capital allocation. Control in markets is rarely absolute. It depends on balance. When supply and demand are evenly matched, mechanisms function smoothly. When imbalance grows, control becomes harder to maintain. Silver's global signals suggested that balance had shifted, not catastrophically, but decisively. The system could still operate, but with less margin for error. The suspense at this stage was rooted in timing. Structural changes do not unfold all at once. They progress in stages. The first stage is denial, followed by adjustment, then normalization. Silver had moved beyond denial and into adjustment. Normalization had not yet occurred. That meant volatility, reassessment, and potential friction lay ahead. For decision makers watching from a strategic vantage point, the lesson was sobering. Global markets were confirming what local data had hinted at. Silver was no longer governed solely by familiar centers of influence. Control was diffusing, driven by physical demand, international flows, and strategic necessity. Once that process begins, reversing it becomes increasingly difficult. The question was no longer whether silver's rise was justified. The question was how far-reaching the consequences of that justification would be. As global confirmation solidified, the space for complacency narrowed. The market was sending a warning, not through rhetoric, but through alignment. When signals align across borders, they are rarely wrong. The strategic consequences. No one can ignore. When a market crosses a historic threshold, the greatest risk is not misjudging price. It is misjudging meaning. Silver moving above $100 was not simply a signal about a metal. It was a message about the frameworks used to understand risk, value, and stability. For decision makers, this was the moment where passive observation ended and strategic reassessment became unavoidable. For decades, silver occupied an awkward position in capital allocation models. It was too volatile to be treated as a stable store of value and too strategic to be dismissed as a minor industrial input. As a result, it was often underweighted or excluded entirely. That exclusion was justified by historical ranges that no longer applied. Once those ranges broke, the logic supporting exclusion weakened. Silver's behavior began to challenge the assumptions embedded in long-term planning. One of the first areas affected was inflation expectation. Markets do not price inflation solely through consumer indices. They price it through assets that respond to monetary conditions. Silver's rise suggested that inflation risk was being repriced beyond official narratives. This does not imply immediate price instability across the economy. It implies that confidence in long-term purchasing power was eroding. When that erosion occurs, assets linked to real value adjust first. Currency confidence was another quiet casualty. Silver is priced globally, but its movement is often most telling when viewed against currency stability. A sustained rise indicates that holders of capital are seeking refuge from dilution. This behavior does not require panic to be effective. It requires persistence. Silver's repricing suggested that such persistence was emerging, even among conservative participants who traditionally avoid volatility. The implications extended to portfolio theory. Traditional models rely on diversification across asset classes, assumed to behave independently. When a neglected asset begins to assert itself, correlations change. Silver's rise pressured these models by altering its relationship with gold, equities, and currencies. Portfolio managers faced difficult questions. Was silver still a peripheral hedge, or had it become a core signal? Ignoring that question risked exposure to blind spots that only become visible during stress. Another consequence lay in timing. Markets often punish those who wait for certainty. By the time an asset's role is universally acknowledged, the opportunity to adjust smoothly has passed. Silver's breakout placed many decision makers in this uncomfortable position. Act too quickly and risk being wrong. Act too slowly and risk being irrelevant. This tension is characteristic of transition phases, where clarity emerges gradually but consequences accelerate. The broader commodity complex also felt the impact. Silver's move forced reassessment of resource scarcity more generally. If a metal long assumed to be abundant could reprice so sharply, what did that imply for others? This question matters because commodity pricing influences infrastructure planning, industrial strategy, and national policy. A repricing in one area often leads to cascading reviews elsewhere. Importantly, silver's behavior challenged the idea that markets can be indefinitely managed through perception. For years, confidence in financial instruments allowed participants to treat physical constraints as secondary. That confidence depended on the assumption that supply could be mobilized when needed. Silver's rise suggested that this assumption had limits. When physical reality asserts itself, narratives lose power. Markets respond to what exists, not to what is promised. The suspense in this final phase was not about imminent collapse or explosive growth. It was about alignment. Would institutions, policymakers, and businesses align their strategies with the new reality, or would they cling to outdated models? History suggests that alignment comes gradually, often after costly hesitation. Those who adapt early gain flexibility. Those who adapt late face constraint. Silver's repricing also carried a warning about complacency. Long periods of stability can create the illusion that systems are resilient. In truth, stability often masks fragility. The conditions that kept silver subdued for decades also discouraged preparation for change. When change finally arrived, it exposed how little buffer existed. This is a lesson that extends beyond metals. It applies to debt, energy, supply chains, and monetary policy. For leaders and strategists, the message was clear but subtle. Do not focus solely on the number 100. Focus on what it represents. It represents the failure of a long-standing assumption. It represents the cost of ignoring structural signals. And it represents the beginning of a period where decision-making must be based on adaptation rather than precedent. The silver market was not offering certainty. It was offering information. Information about stress points, about confidence, and about the limits of control. Those willing to interpret that information carefully could prepare. Those who dismissed it as noise risked being surprised again. As this phase concluded, one truth stood out. Markets rarely provide clear warnings in advance. They provide them in retrospect, through price. Silver's move above $100 was such a warning. Not loud, not dramatic, but unmistakable to those who understood its language. The question was no longer what silver would do next. The question was whether decision makers would listen before the next signal arrived.